They want to have a stake in it. It's not going to look that complex a few years from now. So yes, there are a ton of catalysts, but bottoms always round out. It's never V-shaped. So it's not like the Clarity Act's going to pass and we're going to be back to 100,000.
BUIDL on multiple chains, but now BUIDL has, a DEX. And soon enough, BUIDL will have a lend borrow, I'd imagine. And then, soon enough, it'll have a yield aggregation or preferred vault aggregation service. Do you think that this is the right way to look at the space overall?
Like owning Green Bay, you don't get profits. Green Bay, you get a cheesehead or something. And in Vanguard, you get to continually lower their fees. That's why their fees are lower than everyone else.
Welcome back to the Rollup. I'm Robbie.
I'm Andy. Robbie and I met at the University of Florida in 2017, where we first found out about digital assets.
We learned a lot along the way, and we're bringing you face to face with the leaders of our industry.
Sit back, relax, and enjoy today's episode.
There he is. Without further ado, Matt Hougan, welcome to the show, man.
I'm so excited to be here. Thanks for having me.
Absolutely. I'm glad that you joined. I've been a longtime follower on Twitter. I think you've got a very reasonable, nuanced, and pragmatic approach to the space. And I'm excited to chat about what you guys have going on at Bitwise.
I love it. I appreciate the kind words.
Absolutely. Well, I think there's been two pieces of news as of late that I think would be great to start with that are right at the apex of this convergence. We're seeing some of the DeFi blue chips work with some of the largest financial institutions in the world. It's pretty incredible. And so I'd love to just get your initial reaction to BlackRock working with Uniswap as a liquidity mechanism for their product BUIDL. And then also Apollo building on top of Morpho. Your first impressions, your reaction to when you saw this in the news, and we'll dig into some of the nuts and bolts.
Yeah, absolutely massive. I think the market hasn't recognized what a big deal this is. This is the world's largest asset manager integrating with the world's leading decentralized exchange to provide liquidity into BUIDL. A second piece that you didn't mention is the CFO of BlackRock saying they will tokenize all their ETFs in the next 3 to 12 months. And then this massive endorsement by Apollo, which is really like the BlackRock of credit, saying it wants to build on Morpho. It's hard to imagine the scale of the importance. This is really opening the door to institutional DeFi. It's a huge first step. If we were in a bull market, these tokens would be plus 100%. We're not, so they're basically flat. But I really think it's a critical event in the history of DeFi infrastructure. I'm really excited about it.
Yeah. Now I was listening to a podcast that you did recently with The Block, and you mentioned this. BlackRock is I think it was the CFO mentioned that they're going to tokenize these ETFs in short time, in 3 to 12 months, which you said is a foregone conclusion. It's basically happening.
Yeah, that's the thing I think the crypto market may miss. When a big bank says 3 to 12 months, those things are already 90% done. This is not an experiment. It's not an idea. This is something that's happening, and they're just aligning it with their marketing calendar. So I was really taken aback by that. Look, we all know Larry Fink, the CEO of BlackRock, has said every fund, every asset, every stock will be tokenized. But I think even me, a bull in this space, thought that was a 5 or 10 year period. Now 5 or 10 years has shrunk to 3 to 12 months. I think it tells you a lot about the pace at which this is moving.
Yeah. The people in the chat, they're asking, this is a permissioned feature, right? And, if you look at the BlackRock BUIDL partnership with Uniswap, they're working with Securitize in the middle there to make sure that there's qualified individuals and market participants that are, end up getting into the BUIDL fund. How much does the permissioned, aspect of these things separate them from the existing DeFi landscape? My impression was that tokenization, one of the biggest value propositions was always composability. So how much are we, kind of tokenizing for tokenizing's sake without actually getting the main benefit versus, kind of separating these things out?
Sure. I mean, it would be nice if they YOLO shipped for fully decentralized, no AML, KYC, access to everyone, and they went from 0 to 100 miles an hour overnight. That's not the way that these banks work. So what you're saying is absolutely true. This is permission, it's controlled, it's only institutional investors. It is work. It means that the institutional investors want exposure to this, probably because they want to experiment with looping strategies, maybe because they want to borrow against it as collateral. So I would take it as two things. One, a sign that institutions want to do this, and two, the necessary first step for BlackRock to move into full-blown DeFi. I think if you back up and think about DeFi 3 or 4 years ago, there were like 10 major challenges separating us from disrupting all of finance. There were regulatory challenges, there were bandwidth challenges, there were institutional understanding challenges, and then there were these challenges around AML, KYC, and sort of digital identity. We've knocked down all of those other challenges. That's what this signals. The market is mature enough, it is tested enough that BlackRock is willing to attach its reputation to true decentralized exchange, true DeFi. We still need that last piece of AML, KYC, and decentralized identity before we take over the $10 trillion finance market. But going from 0 to 1 is a much bigger deal than going from 1 to 100. And I think we've gone from like 0 to 10. And I think the rest is just a matter of time. So the critics are right. It's limited, but it's a huge step.
I tend to agree with the idea of this being a stepping stone. I think that's the right way to think about it. And I can't help but think that, when we hear Larry Fink talk about tokenization, more recently, he's also talked about basically one chain to rule them all, which I think maybe is an opinion that, his other financial institutional counterparts may not share, but it does signal that he is already thinking about composability to the extent that everything is happening on one unified chain.
Yeah, I think that's reasonable. I think no one knows at this point how it's exactly going to pan out, and my own view is it's more likely to be multi-chain. But I do think he's thinking about where this goes. Look, some context. I come from an ETF background. Maybe I mentioned this on the Block podcast, but I think a lot of the push for BlackRock into tokenization is that they actually missed the ETF game. So BlackRock today is known as the world's largest ETF issuer, but they had to buy the ETF business from Barclays Global Investors after the great financial crisis. So they missed the innovation of ETFs and had to pay up to catch up. And that became a huge business. I think they see tokenization and DeFi as the next wave of that. They're determined not to miss it. Whether it's one chain or multi-chain, almost doesn't matter. What BlackRock thinks, it'll evolve the way it evolves, but it is interesting that they're seeing the big picture. They see how this spans out over time.
Yeah, one of the things that we've noticed on the show just recently has been this transition in previous cycles, which I know you guys and Bitwise have been around for a while. I think since 2017. So you guys have been through multiple cycles. You've seen how the space has evolved. Back in would have been the DeFi summer 2020 era, we started to see a lot of L1s pop up. And this was primarily, around a lot of surge in DeFi as well. And so each chain had kind of the same components with their own skin around them. Every chain had a DEX, every chain had a lend borrow market, and every chain had a yield aggregation service of some kind. It was a very chain-centric way of looking at the world. And now we've noticed that this transition has happened, and it's taken us to more of an asset-centric view of the world. And I'm curious to hear your thoughts on this, because now, we're looking at BUIDL on multiple chains, but now BUIDL has, a DEX, and soon enough, BUIDL will have a lend borrow, I'd imagine. And then, soon enough, it'll have a yield aggregation or preferred vault aggregation service. Do you think that this is the right way to look at this space overall, now that we have some higher quality assets coming into the ecosystem? Or generally kind of tell us about, the pros and cons of what this mental model might give us.
That's a fascinating mental model. I think it's probably accurate, right? It looks a lot more like the traditional market, which is how that is structured. Like there are multiple exchanges where stocks trade, but there is only one stock. There are actually multiple prime brokers lending against that, even though there's one entity. The same is true on the fund side. So I think that is probably the right view of the world. I think, maybe an extension of that is there's probably a power law distribution in terms of, in terms of dexes, in terms of lending markets, in terms of vaults. So I'm not sure it will be one to rule them all. I think it's probably more like a classic 70-30-10 or 70-20-10 distribution is what you end up seeing. But yeah, look, in the end, the people who have real power in any sort of financial ecosystems are the product providers and then the customer aggregators. The actual infrastructure, it's challenging to compete. So I think when you think about where control lies, I would think in the customer aggregators and the product side as much as in these actual dexes.
Hibachi is fast and private perps trading, secured by ZK with Celestia underneath. Go to hibachi.xyz to start trading today.
Want simple? Want fast? Want every chain? Use relay.link, the fastest bridge in crypto. Transfer your assets cross-chain instantly with very low slippage right now on relay.link.
I'd love to dig into that a little bit more. And we've heard this on throughout a variety of different product and market verticals. It's those who own the end customer on the distribution and front end side, and then the bare metal. You know, that is where the money's made. It's this barbell. Everything in the middle tends to get commoditized as people kind of commoditize their complements towards the middle of the stack. And so, you know, as we're looking at the ETF market and some more of the legacy financial products, could you just help? Because a lot of our audience is founders, builders, investors, but crypto native founders, builders, and investors. Could you give us a sense of who currently owns the majority of these two bookends in the legacy finance and ETF world?
Yeah, it's a great question. So in the legacy financial world, it's really the broker dealers and the financial advisors who own all the customers and assets. So it's either Charles Schwab, or if you want to go one layer deeper, it's Morgan Stanley, it's Merrill Lynch, it's UBS, right? They have a huge chunk of the marketing power. And you see that in ETF land, right? ETFs pay effectively a listing fee to be on Charles Schwab to have access to their customers. And sure, like the ETF providers have a certain amount of scale and can build great businesses. But yeah, really where the customers are where it matters. In crypto land, I think people don't pay enough of attention to like the value that Phantom has created or those sorts of wallet-based aggregators. I think there's a huge amount of value there, and you're going to see them monetize that customer relationship and trusted brand over time. Would be my guess.
Yeah. Back in, I think it was 2016 or 2017, there was the original article of the Fat Protocol Thesis, which, you know, was kind of the counterpart to the social media rising of these apps capturing. And then people thought that all the value would accrue down to the L1s with gas fees. Shortly thereafter, you saw the Fat App Thesis, which kind of flipped the barbell back. I think it's been, you know, now the consensus seems to be what you're saying, which is essentially the Fat Wallet Thesis. This is the portal through which people, and I think people like that too, because it's like, oh, I got a fat wallet.
Sounds great. Yeah.
People want that, right?
Yeah.
And yeah, you're right. Those seem to be the entities that are owning most of the customer relationships. I'd probably say, you know, the wallets and the centralized exchanges at this point are where people see custody, and that's their primary access point.
Yeah, I think that's right. I mean, look, the apps can be fatter than in traditional markets because they're two-sided. So they have supply dynamics and demand dynamics, and that allows them to create more defensible moats. So I don't think the apps get squeezed to nothing. I think they're fatter than they are in the traditional markets. But I think the Fat Wallet Thesis, look, I mean, that's how it plays out in every other ecosystem. I would even say you're seeing it play out here. I mean, the largest primitives in DeFi are tiny right now, right? Uniswap is a $3 billion asset, something like that. Aave's $2 billion, massive business. It's trading 20x revenues or something like completely silly given the scale of its growth. I think that explains a lot of it. You do have this power in the fat wallet space. Again, the apps don't get squeezed to nothing here because they're two-sided markets. I think that's really an important differentiation. But I do think there's more power in the wallets than maybe most people have historically given credit to.
Yeah, and just to kind of put a number around this, or you know, kind of tie up this thesis, you know, those who own the customer relationships are able to set prices that everyone else is downstream of and can kind of just pick up the pieces afterwards. And so I think, wallets are in that position now. And then, we've got the other side of the barbell, right? On both the legacy world and also the, DeFi, neo financial side. Um, in typical blockchain companies, bare metal actually kind of is a somewhat neat term, because ultimately these things are machines, especially in proof of work, even in proof of stake. These things kind of all follow down to the bottom of the stack. But in the legacy financial world, when we're thinking about ETFs, what is considered bare metal as you get, to kind of the two barbell ends of the spectrum?
Yeah, that's a great question. I actually don't know what the right analogy is. Part of me wants to say the index providers, which are the bare metal, the intellectual property behind the ETFs. And if you
Okay.
want to look at a beautiful chart, type in MSCI into Yahoo Finance. That's the leading index provider. It's been one of the best investments in the world over the last 30 years. So I think that is like, ultimately where it boils down to. The barest of bare metals, like the custodians, are just completely commoditized and not interesting. But the IP level at like the index level, it's been a great business to be in for a long time, and they've maybe aggregated more value even than some of the ETF issuers. Look, ETF issuers build deep relationships with customers. At Bitwise, we have thousands of clients. We spend time with them. We cross sell them from one product to another. We introduce them to crypto. You can have very strong relationships, but I do think the index level in legacy finance is sort of maybe the equivalent of bare metal. It's the IP behind asset management.
And where does Bitwise sit in this? You got Morgan Stanley, Merrill Lynch, and Charles Schwab on the one side. You've got MSCI on the other side. Where does Bitwise's ETF offering sit?
Yeah, I like to think that we cover both the asset manager and the index side. So we run our own indexes for our index products and design the IP there. And then even on the ETFs themselves, we try to differentiate, right? We're a large staking service provider, so we run our own staking service. We integrate more of that, more vertical integration than maybe a
Mhm.
traditional asset manager, in part because we want to own the stack, in part because on the index side, we haven't been huge fans of how other people have approached indexing crypto. And in part because I think, people trust is at a premium in crypto for legacy finance coming in. And so the people that we've built relationships over 8 years trust us to do a large part of the asset management business. They sort of want a trusted provider.
Yeah. And we're hearing, as we have more of these conversations with people that are sitting in the middle of these two worlds and able to service both sides, that there's a knowledge gap. There's an education gap. And if you can sit in both sides, understand both of these worlds and speak both languages, you're able to serve as a trusted advisor and a teacher of both of these worlds to ultimately help prepare them for what's coming down the pipeline. Like tokenized ETFs from every ETF from BlackRock is going to be tokenized. How are you helping your clientele prepare for the changes that causes in the world?
Yeah, I love that. I mean, that's how we built Bitwise for what it's worth. About half of us come from asset management backgrounds and half of us come from the tech space, because I do think you need to understand both sides. The answer is we just spend a lot of time with clients. We do 15,000 meetings a year with advisors. We'll meet the average advisor we have a relationship with 4 to 6 times a year. We'll send them, high quality materials. And when we take something like vaults, they have never heard of the term.
Mm.
They want to know how a vault actually works at sort of a base level, like where money goes in, how it goes to somewhere else, how you manage risk, how you monitor the ecosystem, how you make sure the lending pools you're in aren't fully allocated. So they want to understand the nuts and bolts, and it's just a matter of spending a lot of time with them. It's exhausting building a business, but it pays off eventually. So it really is just hand-to-hand combat with people.
I'd imagine vaults to asset managers are a lot like AI to everyone else. Like in the sense that the people that, get caught off guard and fall behind are maybe going to get innovated out of it. But asset managers that utilize vaults, learn about it, try to, incorporate them into their asset management business, are going to end up using them as a tool to further ahead their business.
100%. I mean, look, I think all assets will eventually be managed in vaults. I think vaults will disrupt the traditional fund structure
Mhm.
in a really fundamental way. Obviously, they're starting at a small space. They're starting with yield only, but there's nothing about the idea of sort of dematerializing asset management, making it pure IP and execution that can't be applied to basically every area in the market. I think you'll see the most forward-thinking traditional asset managers follow our and other leads in moving into vaults, right? I think Bitwise is maybe the first sort of traditional asset manager that's building in vaults, but I think others will follow us pretty quickly because it's the next phase. And like you said, look, we've seen this before. I keep coming up with ETFs because I used to run ETF.com before I joined Bitwise. But when ETFs launched, they were disruptive to mutual funds, and you had some firms that seized on that and some firms who stuck in mutual fund land. And the mutual fund firms are now effectively out of business or no one talks about them, and everyone is doing ETFs. In 20 years, the same will be true with vaults. It will all be vaults. It's dematerialized asset management. And we're hopeful that this creates a huge opportunity for the people who are first, like Bitwise. Look, we're not BlackRock, but maybe in vaults land, we could become one of the leading providers. At least that's the vision we're pursuing.
Very cool.
Looking for yield that stands out? infiniFi gives you just that. Deposit stablecoins and earn far more than the current savings rate. infiniFi is a battle-tested, reliable DeFi platform that is ready to go. Head to infinifi.xyz.
I want to get an understanding of what you guys are currently doing in Vault and what your experience has been, but I can't help. Any chance I get, I want to increase my understanding and experience of the legacy financial world. And coming from that world, I'm curious, why were ETFs so transformative to the legacy financial markets? What did they do to money market funds that caught the MFs, caught them off guard, and why were they so innovative?
Yeah, they had a number of key advantages. So one is that they're more tax efficient. Actually, in a traditional mutual fund, if you and I were in a mutual fund and you decided to sell out of the mutual fund and the stocks in the mutual fund had gone up, I would have to pay taxes at the end of the year because you sold, which is an insane reality. But that was how the old system works, right? The word mutual means like we're all in it together. That sounds great, except for when you sell and I pay your taxes. That's less great. So that was not a good starting point. They also traded intraday, 9:30 to 4 instead of once per day. One of the big ironies to me is all the ETF people are now looking at tokenization and like, we don't need to trade 24/7. I'm like, guys, the mutual fund people said the same thing about ETFs. We don't need to trade 9:30 to 4. Once a day is fine. So they were more liquid. And then after they got to scale, they were cheaper. And that's also something people don't get. Like building a vaults business now is hard. It's complex. The tools are imperfect. It's expensive. Bitwise is losing money on it because we have multiple people doing it. Yes, ETFs were also more expensive than mutual funds. But at the bare metal level, ETFs are a more efficient mechanism for bringing in capital and deploying it than traditional mutual funds. So once you got to a scale, they were cheaper, more tax efficient, and more liquid. And that's why they won. When I look at vaults right now, more expensive, a little corner of the market, sort of annoying. But in the end of the day, it's 24/7. It will end up being much cheaper to run for asset management. And it'll be much easier for people to understand. And I think those advantages will eventually win out.
Yeah. Okay. And what are you guys currently doing in vaults? You mentioned your experience thus far. Lost a little bit of money. It's been difficult. It's been, a tech lift. I'm also curious what the material that you're sending out to asset managers, what does that consist of? And what do you find resonates most with those asset managers that might be a little bit more traditional? They're like, I'm hearing a lot about tokenization. I guess I got to learn, I got to read up on it. What is this new vaults thing? How do you help train them and bring them up to speed?
Yeah, sure. So I think you should think about the vault strategy as like two trains moving at different paces. So what Bitwise has done is building like a really conservative prime vault that's lending into Morpho pools for collateralized Bitcoin and ETH, right? The most plain vanilla thing. There are other people that are great firms that do a similar thing. The reason Bitwise maybe has a space there is because we're, a registered RIA, and we have a certain size and scale and regulatory status and systems. And there will be some people who are using other vaults who may be interested in what Bitwise is doing. That's like a V1. You can imagine that serving that audience, which is mostly a crypto native audience, there will be a V2 of vaults, a V3 of vaults, more complex vaults, taking on more risk, more differentiated exposure. So that's one train, and that's actually like the immediate monetization train, if you will. That's like the business we're serving. The other thing we're doing is we're educating people about what vaults are. They're probably the traditional legacy world. They're probably not going to allocate to vaults in the next couple of years, but they value the relationship with Bitwise. And so introducing them to this area and helping them understand it makes them feel that Bitwise can be their complete crypto provider. If we weren't doing it, someone else would be doing it. And in 2 years, they probably will be allocating to this space. Or if they're Morgan Stanley, maybe they're building in the vault space. They want to know, and they need a steward to know that. And so we are doing that as well. So there's really serving the effectively crypto native audience with high quality vaults from a regulated entity. And then there's educating legacy about what vaults are to build our brand and relationship in the space.
Yep, got it. And so these are the two trains moving at different speeds. Yep. And the ETF industry as a whole has a much higher barrier to entry. And I'm thinking about the progression, again, the stepping stone from mutual funds to ETFs to vaults. Given that the barrier of entry to curate one's own vault seems to be much lower than spinning up one's own ETF, are you worried at all that maybe an asset manager might take this material and say, hey, this sounds great, rather than allocating to Bitwise's vaults, I'm just going to go spin up my own and put all my funds in there?
Bring it. Nice. I mean, people ask me a similar question about, are you sad that BlackRock is in the market and has such a huge ETF in IBIT when you have been here for 8 years and you only have like a couple $2 billion in BITB? Yes. And my assets are up 15x since BlackRock entered the market. So I'll take it. Right. So look, will traditional asset managers come into vaults? Absolutely. Will they be able to compete for the current users of vaults for whom Bitwise's brand is maybe more resonant than some legacy providers? We'll see. But will they grow the vault space if they come into it? Absolutely. And remember, like the vault space is tiny right now, right? The broader market is measured in hundreds of trillions of dollars. So there's plenty to go. So no, at this point, it's like a rising tide. I think that BlackRock ETF analogy is a good one.
Very cool. And as BlackRock tokenizes more of these ETFs, vaults become more ubiquitous. Composability, I still think is the paramount value proposition of tokenization. Do you anticipate that these vault strategies start to incorporate tokenized ETFs, start to incorporate tokenized treasuries? These things start to become more blended, and we see a lot more of these tokenized structured products end up in vaults?
Yes, absolutely. I think that's the direction of travel. And we're really excited about that. And I think you're going to see vault managers help tokenize products and push that along so that they can use them, particularly as vaults. Well, even when vaults are really focused on yield, but over time, I expect them to expand to other sort of investment objectives as well. So yes, absolutely. And I would add the other angle of the lower cost to entry for vaults is it's cheaper to spin up a new vault. So it's interesting that you mentioned structured products. In legacy finance, structured products are these specialized exposures that are sold to really wealthy clients. They take time and lawyers and fees to build. They're somewhat cumbersome, but they can be very profitable. They can be very interesting. It's so much easier to build novel products in vaults. Like not just the cost to enter, but the cost to innovate is dramatically lower. That I think you're going to see a lot of specialized exposures. My bet is that much of the market will rely on brand. So I think people who built good brands in Vault, the Gauntlets, the Steakhouses, hopefully the Bitwises of the world, I think most of the money will go into the top brands and then look at all these interesting sliver strategies as opposed to just entering the vault space in the wild savannah and having a billion names and trying to pick one. I think they'll aggregate to brand, and then there'll be a billion strategies within brands. That's probably more of the innovation funnel.
I heard you talking about Vanguard vaults. Like the branding of that is just spot on. We like to dabble a little bit in branding ourselves, maybe Bitwise baskets.
I like it. I like it. Let me register the URL.
Yeah, we'll get the marketing team on it after this. Very cool. Yeah, I think this is again just a DeFi primitive that we're going to see spiral upwards in terms of adoption as more tokenized products and tokenized assets come on chain. I think we're also going to see a lot more of the as more of these things happen on chain. It happened much faster than I expected. That BlackRock started to position into Uni, and Apollo started to get position into Morpho. I did not think. I thought I figured there was a progression, like you were saying, right? First we tokenize the assets, then these assets become integrated and composable with DeFi, and then you end up buying the governance token, if you will, or the network token, right? You get a stake if you end up really investing heavily into a particular mechanism or protocol. This happened almost in one fell swoop. Did you think this was going to happen so quickly, or why do you think BlackRock and Apollo are choosing to make these activations now versus later once Clarity Act is enacted or once it becomes more widely accepted?
Yeah, no, it's wild to me, to be honest. I didn't have it on my bingo card at all. I mean, seeing it makes perfect sense, right? Why did Facebook buy Oculus or Insta or whatever? Because it was sort of an existential threat to their business, a big new operating system, a big way to onboard customers. I think if you look at Apollo and think about what Morpho means, it makes a lot of sense, particularly at the really low valuation that these protocols are operating in. And then also from a governance perspective, they want to influence the direction of travel for these protocols. So it makes sense, but it was shocking to me. I think I'm still a little stung. Like I'm still, part of my mind is stuck in like the Gensler era where anything crypto is toxic and large innovative asset managers are like, no way. And I really think we're now not just in a positive era, but in an aggressively positive era, right? We in crypto forget that Paul Atkins, the chair of the SEC, is going on CNBC and saying all assets will be tokenized and move over blockchain-based rails in 5 years. But for BlackRock, Paul Atkins is the most important person in the world. He is saying this is the way the market is going. And so BlackRock is responding by saying, okay, we will go that way. When I think about it that way, it makes perfect sense. I just didn't expect that. I think because I still have this Gensler anchor dragging me down behind the scenes.
Yeah.
But if you reframe it, it makes a lot of sense.
Well, I think BlackRock is moving faster than really anyone in the typical blockchain startup complex. We're the ones that are used to moving fast and breaking things. I heard you say YOLO shipping earlier, like test and prod. That was the spirit of the industry. And now you have BlackRock moving this quickly because they're listening to the regulators, whereas there's a significant drag that all of us, I think, still feel as a result of Gensler. This, bifurcation between foundations and labs corporations that was created because Gensler pushed pretty much all of these companies offshore, caused, these fugazi foundations to be spun up. Those were the issuing entities of the tokens. And on the other side, you had, real shareholder value and venture capital pouring into labs corps, and all of the value accruing to those equities because it regulatorily couldn't flow to the tokens, which were offshore. And this is still being felt, I think, across the industry. And it's part of why, we haven't seen kind of the catch up that a lot of us would like to see.
Yeah, I think that's exactly right. But I think it's important for people to recognize that they had to do it, right? If you had a way to accrue value, or to put it in regulatory speak, if you could profit from the actions of others, then under the Gensler era, that satisfied the Howey test. You were security and you went to jail. So you had to build a token that couldn't profit. I mean, right? Like that was the rule. It couldn't profit. And so they didn't. I think the mistake people make now, and you're starting to see this addressed in things like what Aave has done with Aavenomics, and then with the Aave will win proposal, is the tokenomics can improve. And there is a natural tension in the market where I don't think protocols will succeed if they don't share the value, at least between the labs and the token. And maybe all of the value needs to end up in the token over time, even if they're IP style purchases like what you saw in the Aave will win proposal. I think people are maybe making the mistake. They're underestimating how much value these protocol tokens can claim in the future by changing the tokenomics over time. Because again, we have this ghost of Gary Gensler keeping us in a poverty mindset. But I think maybe we're out of that mindset. Maybe we're going to stretch from it.
Yeah. Yeah. The ghost of Gary Gensler, I think is right.
He haunts my dreams, man.
Yeah. That's the article, right? That can go out to asset managers for this educational material. I think you're absolutely right. There was an article that went out by Jake Chervinsky and Jesse Walden of Variant Fund, which kind of put some framing around this. And I think you used the moniker protocol tokens, which is exceptionally accurate, I think, in terms of how the value should accrue, at least according to this article, was that value generated on-chain stays on-chain, accrues to tokens. Value accrued off-chain, generated off-chain, accrues to equity. And, in the case of the Aave will win proposal, we had Stani on the show last week. He was unpacking kind of, what the proposal entails, taking the two buckets. You got the protocol layer. This includes Aave v3, Aave Horizon, a lot of, the fees that are built up in that. And then you've got, all the IP, the brand, the foundation, the Aave.com, all of that, the Aave mobile app that they're looking to spin up, all of that is in this product layer. I found it interesting after reading, we had Stani on first, then I ended up reading this article. Aave is talking about directing 100% of the revenues being the product layer, the off-chain value accrual, and the protocol layer, the on-chain value. All of that goes to the token. And I'm thinking to myself, if I'm an investor in Aave Labs, I'm pissed. Like, all the revenues going to the token now. They're going to get a lot of subsidies from the DAO Treasury, but yeah, where do you stand on this? Is on-chain stays on-chain, off-chain stays off-chain, or is that the right way to think about it? You have a different mental model here.
Yeah, I mean, I like all the value going to the tokens. I think it's simpler and cleaner. There may be a world, like a Red Hat style world, where a labs entity can do corporate installations on open source protocols. But I like the direction of travel that Aave is going. Obviously, you have to deal. It's a hard situation, right? Like, you've ended up in a hard place. But I do think the ideal starting place, if you had to do it all over again and you were freed from the Gary Gensler constraint, you were starting from budget zero, you would probably just have it all accrue in one place.
Mm-hmm.
Right? You wouldn't have this two-headed Frankenstein. So to the extent that we can get there, even if it's painful, I think that's positive. Now, I'm not an investor in Aave Labs, so I may feel differently if I was on the other side of the spectrum. But I do think, thinking about where you would, like, from a zero budget perspective, how you would design it,
mm-hmm.
it'd probably just be one thing,
yeah.
Right? And so if we can get there, even if it's painful, and you think this has the potential to 100x from a business entity perspective, then it's worth getting there and solving that challenge.
Yeah. Yeah. And, we talked earlier about, one vehicle on multiple venues, which I think is ultimately the place we want to land. Obviously, Aave is approaching it from, the token angle. They have the Labs Corp, right, which may go places as well. And then you've got people on the other side. Take, BitGo, for example, recently went public. had this native token or native equity that was tradable on chain. Not really, I guess it's a token, kinda. It's still the equity. And so, they're kind of approaching it from the other angle. And so is which model does this ultimately get us to the same place? They're just kind of approaching it from different angles.
Yeah, I mean, I think ultimately the idea is unification and single economic exposure, and we were forced into this odd fracturing by a hostile regulatory environment. We still have an uncertain regulatory environment, right? We don't have the Clarity Act, we don't have fixed rules of the road. We have proposals from Atkins, but we don't have detailed regulation. So all of these are sort of early movers in the direction, but ultimately. It's ideal if everything fits into one in most cases, is my view. So I do hope that we get there.
Yeah. And I think ultimately a lot of, there's regulatory reasons to get there now, and people want to unify the liquidity around these things. The investors want, a unified vehicle where they can retain exposure to all of these things. You guys are another one, right? With the vaults, you're generating some revenues on chain, and then you've got plenty of off chain products as well. How are you thinking? People want exposure here, right? Like, I'm not saying Bitwise token, but how are you guys approaching this? Internally.
Yeah, it's a great question. It's above my pay grade. You'd have to ask Hunter, our CEO.
We'll get him on. Let's get him on next time.
Let's get him on. Yeah, I'm sure he would love to come on and talk about it. I think it's a fair question, right? Like. From a philosophical view, I think we have a problem with companies staying private too long. I'm not saying Bitwise is in that class, but we do have that problem as a society. I think it would be great to give people earlier exposure. I also think, and maybe this is like not the angle you were going, but I think it's true that the idea of using equity to incentivize consumer behavior in smart ways is something that society hasn't explored and becomes infinitely easier when we get security tokens. And I wouldn't be surprised to see some interesting experiments along those lines. Yeah, I think that could definitely happen to make a fun legacy finance point. For what it's worth, Vanguard is actually a collective. It's owned by the shareholders of its funds. It doesn't accrue profits and pay it out to those shareholders. And instead, it continually lowers its cost to benefit those shareholders. But it's actually like pretty close to a DAO, which is almost ironic given their view of crypto. But I do think you're going to see more of those experiments that align sort of shareholder incentives with activity in a company. So I don't know if Bitwise will get there, but I think you'll see other people do it.
Very cool. Yeah, I wasn't aware that Vanguard was structured that way. When you say it's structured like a collective, I guess the closest that I was thinking was like the Green Bay Packers, I think, are owned by citizens of Green Bay, right?
That's exactly right. Yeah, it's similar to that. So if you own a Vanguard fund, you own Vanguard. And but like owning Green Bay, you don't get profits. Green Bay, you get a cheesehead or something. And in Vanguard, you get to continually lower their fees. That's why their fees are lower than everyone else, because there is no profit layer there, which is interesting.
Yeah, and ultimately, provides a better product and service than a lot of others, on the market. Very, very cool. Matt, I guess as we kind of close out here in the next few minutes, I'm sure, I heard you, discussing some market takes on a couple other podcasts, but I'm not asking you to call bottoms here. I just, I'm curious as far as like how you're thinking of positioning. Actually, what I wanted to ask was about the DATs. A lot of people are predicting that DATs are going to be like, once they unwind, it's necessary in order for this market to bottom. If the DATs don't capitulate, right, we're not going to go up. How do you feel about, these treasury companies? Do you think it's necessary to shake them out before we go higher?
Well, I think you need to separate DATs. So you have the mega DATs like Strategy or Bitmine or Forward that are missionaries in the space, that are completely aligned with their tokens, and that have high enterprise value and very low debt. Like even MicroStrategy or Strategy has very low debt compared to their Bitcoin position. I think there's no way an entity like Strategy unwinds in the next 5 to 10 years, and probably ever. because you'd have to have Bitcoin go down 80% and then stay there for 3 years, and then a bunch of other things happen for them to get into trouble. It's just not going to happen. So if we're waiting for them to unwind before we bottom, we should get into another business. It's going to be a long time. Some of these lesser DATs that were late to market, I absolutely think they'll unwind and pivot. But the scale of those are relatively small. So if crypto natives need a body to sacrifice on the altar, I think the DAT gods will offer them up a body at some point. But it won't be like it won't really matter, because it won't be that much Bitcoin that they sell or that much ETH that they sell. So I think it's more a narrative thing. You're not going to get Strategy or Bitmine or others into trouble. Just mechanically, financially, it sort of can't happen.
Sacrifice a DAT at the altar and to the ghost of Gary Gensler, and he washes away all of our.
If that's what it takes, I hope someone raises their hand to be the sacrifice. Let's get it done and move on.
Yeah. And you've also said that, BlackRock, positioning into Uniswap, Apollo into Morpho, these are things that ultimately bring us out of a bear market or a crypto winter. Anything else that you think could be like a big catalyst? Do you think the Clarity Act holds a lot of weight? Anything else that you think, is relevant enough that it could cause some, and at the macro scale too, how much are you paying attention to the new Fed chair, easing monetary policy, these sorts of things as you're, thinking through the investment strategy at Bitwise?
Yeah, absolutely. Look, if you position yourself out 3 years from now and you're looking back and you're like, wow, how did we bottom and then go into a historic bull market? Well, stablecoins went from 300 billion to $3 trillion. Tokenization went from 20 billion to $200 trillion. BlackRock and others were building in DeFi and buying Morpho and Uniswap tokens. You had quantum risk being put to bed by Bitcoin core developers. Kevin Warsh cut rates more than people expected. Maybe we pass the Clarity Act, maybe we don't. But there's like so many positives. I keep hearing people saying this is worse than 2022 or worse than 2018. That's absolutely ridiculous. There were existential threats then and no positives. When you put all of those things together, look, in 3 years, it will be obvious why we rallied. Those are massive markets. And right now they're really undervalued. I do think DeFi could lead us out. Like, listen to Apollo, listen to BlackRock, look at these valuations. Like, Morpho's $1.5 billion, largest credit fund. They want to have a stake in it. It's not gonna look that complex a few years from now. So yes, there are a ton of catalysts, but bottoms always round out. It's never V-shaped. So it's not like the Clarity Act's gonna pass, and we're gonna be back to 100,000. It's not what's gonna happen. It's gonna be this accumulation of good news that gets ignored until it's so weighty that it's just obvious, and then we'll be at new all-time highs.
Mm-hmm. Yeah, I think that's a prudent approach. Matt, last question I got for you is, we've been thinking a lot about where the space is heading. You've been around for multiple cycles. We've been around creating educational content in the space for multiple cycles. It feels like finally these institutions are being forced to innovate. They're evolving, and then at the same time, a lot of DeFi is starting to find some product market fit. There's a lot of infrastructure that never really found product market fit. Maybe they never do. They're being forced to innovate as well. Where these things are meeting is it looks a lot different. It's not really seed phrases and self-custody. People want forgot password buttons and customer service. They also, they want a neobank approach. They want vaults. They want tokenization and composability. We're calling this neo-finance. And we think it has to be something that, not DeFi 1.0, 2.0. We've done that, right? Like, we're trying to come up with what we think the new moniker is. I'm just curious, do you think this is the right way to think about it? Would we see neo finance go out to some asset managers and Bitwise educational material? What do you think is the right mental model? How do you think about neo finance?
I like that. I like the term. I do think we're reinventing finance. I think it's way overdue. Fintech has effectively been a failure. Finance is the least disrupted sector in the economy. The largest financial services company in the US was created in the 1700s. That's like embarrassing. So I do like the idea of neo finance. I think it is important to get out of crypto specific terms.
Mhm.
Crypto terms are limiting. Even decentralized is relatively limiting. And many crypto terms are actually negative in the real world, like trustless sounds bad. Even zero knowledge proofs no one wants zero knowledge, sounds bad. So yeah, I like neo finance. I do think the scale of it is right. Yeah, ultimately this, like, again, the scale is like vaults take all of asset management. Stablecoins take all of payments. On-chain lending markets replace all of lending. I think that's the scale that we're going. So something like neo finance is a pretty good term.
Awesome. Appreciate you saying that, and appreciate you coming on today. It was a pleasure. Would love to have you on again, in a couple months to reassess where we are at. Hopefully in the crypto spring and the neo finance next era, I guess.
I love it. I
We'll
love it.
see.
We'll do it for sure.
Awesome. Thanks so much, man. Really appreciate it. See you
Thanks
again
for having
soon.
me.